Ever wondered why a single percentage point can change the course of an economy or even your personal finances? Imagine having the power to influence what you pay on loans or earn on savings, all thanks to interest rates. Interest rates are essentially the cost of borrowing money or the reward for saving or investing it. Let's start with the basics. When you take out a loan, whether for a house, a car, or education, you're charged an interest rate. This is a percentage of the loan amount that you must pay back, in addition to the principal. Now, if you're saving money in a bank, interest works in your favor. The bank pays you an interest rate for the privilege of using your money. Here's why it matters. Central banks adjust interest rates to control economic stability. Lowering rates tends to stimulate spending and investing because borrowing is cheaper and saving less rewarding. Conversely, hiking rates makes borrowing more expensive, cooling down an overheated economy. For individuals, understanding rates helps with budgeting and planning for the future. Whether you're saving for a vacation or planning to buy a home, knowing how interest rates work can empower you to make smarter financial decisions. Let's break this down further. Consider how interest rates affect the housing market. A slight drop in mortgage rates can make homeownership more accessible for many by reducing monthly payments, which sparks increased demand for homes. On the flip side, when rates increase, the cost of borrowing goes up, slowing down demand and potentially stabilizing or even lowering housing prices. But it's not just real estate. Interest rates also ripple through the stock market. When rates are low, investors often seek higher returns in stocks. In contrast, rising rates can create a shift towards fixed income investments like bonds, which become more attractive as their yields increase. Now, here's a kicker you might not have thought about: your credit card debt. Credit card interest rates are often variable and can rise alongside overall market rates. That means managing existing debt becomes more crucial as rates climb. Still curious? There's compound interest, the concept of earning interest on interest, which can drastically impact your long-term savings. It's like planting a tree that grows more branches over time, each producing its own fruit. Understanding these nuances empowers you, not just to navigate your finances effectively, but to optimize and capitalize on opportunities as they arise. So, next time you hear about rate cuts or hikes, you'll know exactly how to interpret the signals. Let's dig into something called the real interest rate, which strips away inflation to reveal the true cost or yield of money. Inflation is like a stealthy thief. It eats away at the purchasing power of your money. So, even if you're earning interest on your savings, if inflation is higher than your rate, you might actually be losing value over time. That's where understanding real interest rates gives you the edge. Picture this. You've invested in a bond with a 3% interest rate, but inflation is running at 2%. Your real interest rate is only 1%. Why does this matter? Because it affects your financial decisions, from the assets you invest in to the savings account you choose. Another crucial player is the central bank, often the wizard behind the curtain. By setting the benchmark interest rate, they guide the economy's tempo. Lower rates can encourage borrowing and investment, fueling growth, while higher rates can put the brakes on an overheating economy, curbing inflation. Yet, every decision has ripple effects. Fluctuating rates influence currency exchange rates, which matter if you're doing business internationally or even planning trips abroad. Understanding these levers, the real interest rate, central bank strategies, and global impacts, turns you from a passive observer of economic forces into an informed participant. Curious about how these affect your day-to-day financial decisions? It's all interconnected, and knowing these connections helps you make smarter moves. Now that we've pulled back the curtain on interest rates, let's explore how they play out in different economic environments. Consider a booming economy. With consumer confidence high and spending up, central banks might raise interest rates to prevent overheating. This move can cool down inflation and encourage people to save rather than spend, stabilizing growth. But what about in a downturn? In a recession, lowering interest rates can ignite economic activity. Borrowing becomes cheaper, encouraging businesses to invest and consumers to spend, sparking economic recovery. However, Historically low rates sometimes lead to unintended consequences, like asset bubbles. Here's a question. What if interest rates are already low and the economy needs a boost? Enter unconventional monetary policies like quantitative easing. It's a fancy term for central banks buying financial assets to pump money into the economy. Think of it as giving the economy a shot of adrenaline when traditional interest rate adjustments aren't enough. Sometimes, however, interest rates might not affect everyone equally. Those with fixed-rate loans aren't immediately impacted by rate hikes or cuts, while variable-rate loans are directly tied to these changes. Whether strategizing investments or managing debt, understanding these nuances can help you anticipate changes and adapt your finances accordingly. With each new layer we've peeled back, you're better equipped to harness the dynamics of interest rates to your advantage. Curious about your next financial move? You're in a stronger position to decide. Let's turn our focus to the global stage and the interplay of interest rates across countries. Imagine interest rates like a set of interconnected gears in a complex machine. Changes in one country can ripple through to others. For instance, if the U.S. Federal Reserve hikes rates, it often attracts foreign investors seeking higher returns, leading to a stronger dollar. Why does a stronger dollar matter? It can make U.S. exports more expensive for international buyers, potentially reducing demand for American products abroad. Conversely, emerging markets might face challenges as capital flows back to the U.S., putting pressure on their own economies. Now, consider currency exchange options. If you're traveling or doing business overseas, interest rates will influence exchange rates. A hike in interest rates can strengthen a currency, while cuts may weaken it. Timing currency exchanges strategically can save money or enhance overseas purchase power. Moreover, let's not forget the power of market sentiment. Investors' expectations about future interest rates can sway markets. If everyone believes rates will rise, bond prices may drop in anticipation, affecting your portfolio. Lastly, never underestimate the human factor. Whenever central banks signal changes, it impacts not just numbers, but people's expectations and confidence. Understanding this can give you insights into both short-term market reactions and long-term economic shifts. By now, you're becoming an expert navigator of the interest rate landscape. So as you move forward, armed with knowledge, you can make financial decisions that aren't just smart, but strategically astute. So we've journeyed through the world of interest rates, uncovering their influence on everything from personal loans to international economies. We've seen how they can sway markets, affect currencies, and ultimately impact our daily lives and financial plans. By understanding these dynamics, you've gained an edge in making informed decisions that can shape your financial future. If this information has empowered you, make sure to hit that like button and share it with friends who might also benefit. Subscribe to our channel to stay updated with more insights that will help optimize your financial journey. Remember, the more you know, the better you can maneuver through the world of finance. Keep learning, stay curious, and let's continue navigating these economic landscapes together.